Welcome everyone. Today we're looking on Realty Income, one of the top picks for many dividend investors. Known as the monthly dividend company, the stock currently is trading on a quite historical low multiple of just around 12 times AFFO. But what makes Realty Income so interesting for many retail investors? Well, as one of the most recognized REITs in the investment field, it pays monthly dividends. And thereby the stock seems very attractive for those who want a nice, consistent, paid-out passive income. I would like to start the video with a bit of background. The company was founded in 1969 in San Diego. It's a REIT, which means they normally have to pay out at least 90% of its profits. And the company is specialized in acquiring and managing commercial properties, especially retail properties. Their business model is based on leasing its properties under long term by triple net lease agreements. This means tenants pay most of the operating expenses, including taxes, maintenance, and insurance. Or let's just say most of the trouble that comes with real estate, they just delegate on their tenants. And this provides steady and predictable cash flows for the company. In 2021, there was a spin-off, the Orion Office REIT, spinning off most of their office properties. After the spin-off, Realty Income primarily focused on owning retail properties. They have around 13,000 units in total, of which 80% are retail properties. And the rest is some industrial properties and some agricultural properties. And retail properties are shopping centers, retail outlets, boutiques, and similar properties. Now let's talk about the dividend. Realty Income has become a role model of consistency in paying out their monthly dividend every month since 1969. Yes, every single month since 1969. On their website, they just declared the 641st consecutive monthly dividend. And this monthly dividend approach is what makes it so interesting for investors who just want a nice steady payout. They just increased their dividend a tiny bit in September 23. Now they pay out 25.6 cents per month or $3.07 per year. At the price of $53, that's a current dividend yield of 5.8%. The consistency of monthly dividend payout and their increases over the years are a core element of the company's strategy. And they show their commitment quite direct on their website. For example, when you just open their website, they directly call themselves the monthly dividend company. Like, we are the monthly dividend company, indicating they will pay dividends every month as long as it's somehow possible for the company. When we click on what we do here, we see again written, they commit to their stockholders and dividends. And when we go on investor ratings here, they directly say again, Realty Income is committed to providing our shareholders with dependable monthly dividends. So yes, the dividend policy is great and all, but we must see also that this has another side, capital increases. The last capital increase was just in February 23 by around 800 million US dollars. They do that by printing additional shares, which dilutes the equity of existing shareholders, but at least this causes not the company to go deeper in debt. In the year 22, they had around a total of $6 billion US in issuance of common stock, which is quite high considering the revenue is just around $4 billion US per year. And also the growth of the dividend is rather moderate. As we can see here, it's on average growing by a few percent per year, but at least they increase very consistently. They had over 100 consecutive quarterly increases of the dividend, which means they increased the dividend every quarter for more than 25 years. Now let's talk about their portfolio and also a bit about valuation. The portfolio comprises 13,000 real estate properties, which have a book value of 48 billion US dollar. They earn around $3.9 billion in rent per year. We can see here that the rent has gone up nicely over the years. And actually, generally, when we look at the opinion of analysts, we see it's all green here. And we talked before about the dilution of shares by printing more shares. So the revenue is up, but there's also much more outstanding shares than a few years ago. So maybe it's better to look at revenue per share instead of just the revenue. And yeah, you can just see a few pictures of properties here. The revenue per share also went up nicely year by year. This year around 6% higher than last year and around 22% higher than just 3 years ago. And I really like to look at revenue per share because it gives me a very raw, simple, but relevant and authentic look on the success of the company. They have an occupancy rate of around 99%, which is perfect. When we look at the AFFO per share, we see it also went up, but slower, on average a few percent per year. We currently have a price per FFO ratio of around 12 to 13, which is historically quite low. And by the way, the AFFO is the most commonly used number in REITs to give a better picture on the company's actual operative performance and profitability. The portfolio quality is generally perceived as good. Just one tenant, Cineworld, recently went bankrupt. Realty Income had 41 properties rented out to Cineworld. Despite of Cineworld's bankruptcy, the company managed to secure the biggest part of the rental income. Cineworld was restructured, and right now they still rent 35 locations from Realty Income. Acquisition. They just recently acquired Spirit Realty Capital. It just happened end of October 2023 for a price of $9 billion paid in stocks. Most voices are quite positive on the acquisition, stating that the dilution is lower than the gain on the acquisition. The company tells us here that the overall rent will thereby increase by around $700 million. Realty Income has around $20 billion in debt. That's around 8 times FFO, which is perceived as somewhere moderate to rather high than moderate. If you put the 20 billions of debt into relation of the valuation of the real estate properties, which is 48 billion book value, and that's already a careful approach, we have a debt quota of around 40%. And that is already quite a good value. Generally, a value of lower than 50% is already perceived as conservative. Now let's turn our attention to discuss the valuation of the property portfolio. So when we talk of valuation, you know, it's always up for interpretation. The current market value of the whole portfolio is around $38 billion because the stock price went down to $53, right? So $53 times 725 million shares equals to $38 billion market value. Book value is $48 billion, which is a very conservative valuation in the US GAAP standard. It's based on the price the properties were bought for. When it comes to valuation, I prefer to look at the capitalization rate, which means we look at how much the properties earn in rent. So the company earns $4 billion a year in rent. And let's assume that we have a cap rate of an average 7%. This equals to a valuation of around $57 billion for the whole portfolio. So, is it 38 billion, 48 billion, or $57 billion? Pick the number you want. It is clear that, as you surely know already, valuation is always a matter of interpretation. Why is the stock down? All this sounds, all in all, quite good. So why is Realty Income down by almost 35% from its all-time high? Everything is good. They even beat the expectations in Q3 23. So why is the stock down? Let me just give you an overview of bearish arguments for this stock. So first of all, Realty Income has around 80% retail properties. So with this investment, we're not looking for risk. We are looking for a safe play here. So why bother investing in retail properties instead of residential properties? People will always need a place to live, but with retail, there's just more headache. You know, disruption by Amazon or e-commerce in general, and also the up and downs of the economy are a much bigger factor. So why even take on this additional headache? Second, fear of recession. Market participants in the US are waiting already half a year for a recession to come. We have seen signs already, like stress in the bank sector, the collapse of the Silicon Valley Bank, and the worries for longer high interest rates than initially expected, pressuring the markets. They call it higher for longer. And the experience from previous recessions leads market participants to fear that the next recession might have a strong impact on the real estate sector. And number 3, interest rates and inflation. Almost 6% dividend are nice, but nowadays one can already get 4% interest rates just on fixed deposits. And how much are those 6% really when the inflation is at least around the same for the year 2023? You know, inflation just came down in the second half of the year. Okay, then it's still somewhere 4% of inflation in October. So please let me know what you think about all this. I would be very happy to discuss with you in the comments. See you next time. Bye bye.